All right, let's get right into it. Something fundamental, something deep in the financial DNA of the world's most valuable company is changing. And we're not talking about a new product feature or some minor update. We're talking about a complete shift in philosophy that could really redefine who leads the tech world for the next decade. And this question right here, this is the whole ballgame. For more than a decade, Apple was Tim Cook. His genius wasn't just in products, it was in creating this incredibly efficient, money-making machine. But now, with a new hardware chief, John Ternus, guiding the vision, and this AI revolution demanding a totally different playbook, you have to wonder, is that incredible run of growth finally hitting a wall? To really get a grip on where Apple is going, we first have to look back. We have to understand the paradigm that made them this impenetrable fortress in the first place. So let's break down the Tim Cook era because it was built on a very specific and, frankly, brilliant philosophy. 24 times. That's the mind-boggling growth of Apple stock under Tim Cook. Just let that sink in. For years, that number has been the anchor for investors. It represents his golden age of just pure operational mastery. But it also sets an impossibly high bar for what comes next, right? It creates this expectation that, well, it may no longer match the new reality. So this is what we can call the Cook Doctrine. These were the pillars of that success. It was never about chasing every flashy new trend. Nope, it was about perfecting the supply chain until nobody could even come close. It was about building this super high-margin services empire on top of all that hardware, and then, and this is key, returning gigantic piles of cash to shareholders. And the bedrock for all of this? A relentless focus on being capital light. So what does capital light really mean in plain English? Well, think of it like this. Instead of spending billions owning and building your own factories or these massive server farms, Apple basically perfected the art of letting other people do it. They minimized their own capital expenditures, what the finance pros call CapEx. And what did that do? It freed up this absolute ocean of cash, which Wall Street just loved because it meant bigger stock buybacks and fatter dividends coming right back to them. It was hailed as the absolute peak of corporate efficiency. And yeah, the numbers completely back this up. See, analysts often look at this CapEx to earnings ratio, and anything under 25% is seen as a sign of incredible discipline. Apple nailed this mark year after year after year. It was the financial engine of the company. It proved you could make obscene profits without massive physical investment. But that was then. Because, well, a new industrial revolution is here. And the rules of the game? They've been totally rewritten. That super efficient capital light model that made Apple a titan is now facing its biggest challenge ever. It's facing the exact opposite of everything it was built on. And this is the shift you have to understand. AI isn't just some software you can cook up in a lab in Cupertino. It's a business of atoms. It needs real physical stuff on a scale we've literally never seen before. We're talking massive power grids, unbelievable amounts of water for cooling, and huge specialized data centers packed with tens of thousands of GPUs. This is an industrial build-out, and it cost an absolute fortune. And this chart, wow, it just lays bare a shocking difference. On the left, there's Apple, still sticking to its capital light playbook, spending only about 3% of its revenue on CapEx. And on the right, you've got Microsoft going all in on AI, spending over 50% of its revenue on infrastructure in a single quarter. The gap here isn't just big, it's a canyon. Okay, let's put some real numbers to that chart just to see the insane scale of this. Apple is projected to spend about $12.7 billion for an entire year. Microsoft is now spending more than that every single month. And get this, Meta is projecting CapEx that could hit $135 billion in 2026. That one-year spend is more than Apple's entire decade of infrastructure spending combined. It's not just a gap, it's a completely different universe of investment. So this massive spending difference is creating a real paradox, a real head-scratcher in how the market is valuing these companies. And to see it clearly, we just need to look at two key financial ratios that tell a really fascinating and, for Apple shareholders, a pretty uncomfortable story. Okay, this is what we call a valuation inversion. Look at NVIDIA on the right, the king of AI chips, right? Their revenue is growing at a staggering 71%, but the stock trades at a forward price-to-earnings multiple of about 20. Now look at Apple. Their growth is projected at a solid but much, much lower 12%. Yet investors are paying a way higher premium for its stock at almost 29 times earnings. You are literally paying more for way less growth. So why is that such a big deal?
Well, it all comes down to this metric called the PEG ratio. The easiest way to think about it is asking, am I paying a fair price for the growth I'm actually getting? A low PEG ratio is good. It means you're getting a bargain. But for Apple, you've got a high PE ratio combined with low growth, and that results in a PEG ratio that is making the big institutional investors very, very nervous.
And look, this data isn't just some spreadsheet exercise for finance nerds. It is actively driving a quiet but absolutely massive shift in the investment world. We are seeing a rotation of big money away from the old guard and into the new companies that are building the AI revolution. And right here, you can see the two different camps forming. On one side, you've got everyday retail investors. They see Apple as the ultimate forever stock. It's safe, it's a fortress, it churns out $100 billion a year in free cash. But on the other side, you've got the institutions, the pension funds, the hedge funds. They see that scary PEG ratio, they see the lag in AI spending, and they are actively moving their money into the infrastructure enablers, the companies providing the picks and shovels for this new AI gold rush. So, with all this pressure from the market and this huge investment gap staring them in the face, what's Apple's play? What's the new strategy to navigate this capital-heavy world of AI? Well, it looks like Apple is going back to its roots. Under hardware chief John Turnus, the focus is shifting away from that Cook-era doctrine of services and buybacks and going back to a product-first mandate. The big bet here is that the real future of AI isn't just in some distant cloud. It's right on the device in your hand, powered by Apple's own amazing silicon and integrated perfectly into the hardware. And this quote, this perfectly sums up Apple's new message to the world. They're asking for patience. While all their competitors are in this frantic, cash-burning sprint to build out cloud infrastructure, Apple is framing its AI strategy as a long-term marathon. They're betting that a better user experience, on-device privacy, and that classic, elegant hardware integration will ultimately win the race, even if it looks like they're starting from way behind. And that right there leaves us with the ultimate question. Is Apple's slow and steady, hardware-focused marathon a stroke of genius? Are they right that the true value of AI is what you can hold in your hand? Or is this slower, capital-light approach just a case of fighting the last war, leaving them about to be lapped in an AI sprint that is reshaping the entire world before our very eyes? The answer is going to define the next chapter for the most iconic company on Earth.